Hi, Ron Benning, real estate investment expert. If you're watching this video, you're probably working with me or one of my real estate investment expert team members, and you've already looked through the GRM reports to shortlist those properties down to the handful we will now do the next level of analysis on. That next level of analysis is called the Rental Opportunity Report. The limitation of the GRM report is that although it does a great job of letting you know which properties are likely to have the best cash flow potential now, it doesn't consider whether the current rents are at market, below fair market value, or above current market value. Let's take a look at the GRM report and a rental opportunity report to better understand the difference. As you look at the rental opportunity report, you will notice that the report shows the current rents by unit, the current total gross income, and the current GRM. What is different on this report is that we have looked up the fair market rents on Rentometer Pro and plugged them into the report in the columns I'm pointing to now. For the purpose of this report, we will always plug in the average rent in this area on Rentometer. See a link in the description below to see our video on how the Rentometer report works. Once we've done this, the report will reconcile the current rents versus the long-term market rents. When we look at the far right-hand column of the rental opportunity report, you will see a positive or a negative number. If you see a negative number, this is the amount of money monthly that the rents can be raised over time. If there's a positive number, the rents are already at fair market value or above fair market value. As the report title implies, this will show us which properties have the best long-term opportunity. What we will discover is that sometimes there are two properties with a similar GRM, but one of the properties will have much better long-term opportunity for income growth. Given the choice between these two properties, even if the short-term GRM is slightly higher, I would pick the property with a similar GRM but bigger negative number in the report because, like I said earlier, a negative number in the report means this is how much money per month the rents can be increased over time. Often the properties with the best GRM are already at fair market value. These can still be the best properties to buy, but there's no doubt that this report will open your eyes to some hidden gems. It will also alert you to properties where the rents might be artificially high. In those cases, if your property goes vacant, it might be difficult to re-rent at the same rents. In these cases, we need to be cautious not to overpay for cash flow that may not be sustainable. Feel free to reach out to me or the member of my team who sent you this video with any questions. We look forward to helping you successfully find your next investment property.